You're about to hear a story the mainstream hasn't caught on to yet. A story about a metal that's quietly slipping out of the system faster than the system can replace it. And if even half of what insiders are whispering is true, then the biggest player in the game just flipped sides and might be preparing for something huge. So here's the question. What happens when the world's most powerful suppressor becomes the world's biggest accumulator? Yeah, that's where this gets wild. Let's get into it. The hidden plot twist nobody saw coming. For years, the silver market has been like a chessboard where one massive, powerful piece, kept the entire game under control. That piece, JP Morgan. They weren't subtle about it either. People in the industry even called them the gravity of silver because every time the market tried to run higher, they dumped these huge paper contracts at the strangest hours. Middle of the night, low volume moments, boom price, crushed. But here's the twist most people still don't know. Those massive short positions, gone, vanished. And the rumor is they didn't just unwind them, they flipped long. Like really long. And not with paper, they're reportedly sitting on something close to 750 million ounces of physical silver. Just to put that in perspective, if that number is even close, it's the biggest private stash of silver anywhere on the planet. It's the kind of number you only see in textbooks about empires, not banks. So the question becomes, why would the biggest paper hammer suddenly start hoarding the real thing? To understand that, you have to zoom out and look at the actual physics of the silver market because this whole story starts with something simple, something most people overlook. We're running out. The global silver shortage that won't go away. Here's the part nobody talks about on financial TV. For 6 years straight, demand for silver has been higher than supply. Not by a tiny margin, either by 200 to 300 million ounces every single year. This isn't a blip. It's not some weird COVID anomaly. It's not temporary. It's a drain. A slow, steady leak that's been eating away at global stockpiles with no sign of stopping. And every time you look at that deficit, one question pops into your mind. Well, can't we just mine more? You'd think so. But here's the reality. 80% of the world's silver is mined as a byproduct of other metals, copper, lead, zinc, meaning miners don't go out looking for silver, they find it by accident while digging for other stuff. So even if silver hits $200 an ounce, you can't just push a button and get more. You'd need global demand for copper and zinc to explode to justify more drilling, and that's not happening fast enough. And even if someone did discover a giant pure silver deposit tomorrow, there's another issue. It would take 7 to 10 years to bring that mine online. Permits, environmental reviews, infrastructure, construction, financing, then actual production. Silver doesn't care about your timeline. The market isn't set up for fast fixes. That shortage in supply is real, it's structural, and it's getting worse. So if the supply side is choked, what happens next? That's where this story gets crazy. The system built on paper promises is cracking. To understand the next part, you need to know something most people don't. There are two silver markets. One is the paper marketplaces like COMEX, where people trade contracts that say, yeah, I totally promise I'll deliver silver if you ever actually want it. The other is the physical market, where investors, sovereign funds, and central banks buy actual bars, real metal, real weight, real scarcity. For decades, the paper market controlled everything. That's where price was set. And it worked, because almost nobody ever asked for delivery. Andy Schectman, who's been in the metals world for over 30 years, summed it up perfectly. Less than 1% of contracts ever stood for delivery. Think about that. 99 out of 100 trades were made by people who never wanted the metal. They were just betting on price. It was all one big IOU machine. And because nobody wanted delivery, the system could promise the same ounce of silver to multiple traders at once. A little like selling the same car to 10 different people. As long as nobody shows up to drive it home, nobody notices. But then something changed. Not small investors, not retail, the big boys, sovereign wealth funds, central banks, India, China, Russia, Gulf states, they stopped playing the paper game and started saying, yeah, we'll take the metal, thanks. And the numbers? They're nuts. One recent month saw 58 million ounces demanded for delivery in just 12 trading days. 12 days. To put that in perspective, that's like someone showing up to a bank and withdrawing so much cash, the vault manager starts sweating because the drawers are emptying faster than they can refill them. This isn't a leak anymore. It's a flood. And when a system built on IOUs suddenly gets hit with real withdrawals, the truth comes out fast. There's way, way less real silver than the paper said there was. A market disconnect unlike anything we've seen. Now we get to one of the strangest signs that silver is deeply mispriced, the gold to silver ratio. For most of human history, that ratio sat at around 16 to 1. That's the natural ratio of how the metals occur in the Earth's crust. During the Industrial Age, the ratio averaged around 45 to 1. But in 2020, it exploded to 125 to 1, the highest in recorded history. That means silver was so undervalued relative to gold that it didn't even make logical sense anymore. The two metals weren't just out of sync, they were on different planets. This is one reason analysts like Sheckman say silver might be the best value proposition of their entire careers. And then you have junk silver, those pre-1965 US coins that contain 90% silver. Usually they sell above spot because people want them for the metal content. But recently, there were moments when you could buy them for less than the spot price of the silver inside. That's like buying a $10 bill for $9.20. It's backward. It shouldn't happen. But it did. And that's the kind of thing you see during a market that's stretched to its breaking point. Two different worlds, smart money versus public mania. Here's where the contrast becomes almost comical. On one side, you have the smart money megabanks, sovereign funds, quietly draining the world's available silver while the price barely moves. On the other side, you have the general public, pouring money into soaring stock markets, taking on near record margin debt to chase the next hot ticker. It's like watching two totally different movies playing on two screens side by side. Movie A: massive players hoarding real silver, pulling metal off exchanges, preparing for something big. Movie B: retail buying speculative assets on leverage while ignoring hard commodities completely. And here's the real kicker. This whole physical squeeze, this entire shift from paper to real metal, it's happening without the public even paying attention. If retail ever turns its eyes to silver, even a tiny percentage of them, it would be like hitting the turbo boost button on a car that's already redlining. You'd see physical shortages go from tight to panic very quickly. So why isn't this front page news? Because most people still watch the paper price. They see a red candle or a green candle and think that's the whole story. They see $24 or $23 on a screen and assume that number reflects reality. But the paper market is becoming a shadow, an echo of something that's no longer aligned with the real world. The physical market is where the real story is happening. Vast tonnage demanded for delivery, vaults being drained, big banks flipping long, central banks buying metal for the first time in decades. But if you only look at a chart, you miss the chess pieces moving underneath. Let's pull everything together. You've got a global supply deficit running 6 years straight, a mining system that can't respond fast enough, a paper system built on promises that's being stress tested, sovereign funds demanding physical, rumors of JP Morgan flipping from the world's biggest short to the world's biggest long, 750 million ounces allegedly under their control, the highest gold to silver ratio in history, physical coins selling below their melt value, the public completely distracted. Each of those things on their own is interesting. But all of them happening at the same time? That's not normal. That's not random. That's not business as usual. That's a signal. A quiet one. A slow one. One that most people won't notice until it's already done. But it's there. And if the whispers about JP Morgan are true, if the suppressor really has become the accumulator, then the world's most powerful player may already know how this story ends. The summary. So here's the short version. The silver market isn't broken, it's transforming. The shift from paper to physical is already underway. Big money has already moved. The public hasn't. And the window where this stays quiet is closing. The question now isn't whether silver is undervalued. It's whether the world wakes up before the system hits its limit or after. If you want to know what happens next, like this video and subscribe to my channel. See you next time.